Nizam Idris, Managing Director and Head of Strategy Fixed Income Group with Macquarie, joins us live from Singapore. Nizam, good morning and thank you for joining us. Nizam, the Reserve Bank of India yesterday clearly has indicated and communicated that interest rates in India have topped out. But even though the communication has been on expected lines, the surprise factor was the cut in SLR.
Right, the SLR cut, this is the second time that RBI actually cut the SLR, and in my view it is partly a way that the RBI allow more money or more liquidity into the private sector debt market, taking it out of the SLR. SLR is basically what banks are supposed to hold in government bonds as part of their reserves. So that has been lowered by 1 percentage points over two policy meetings, and I think that allows some cash into the private sector debt market.
What's the view on the currency? Do you think it's 62 perhaps is going to be a strong floor for the currency from these levels, Nizam? Or given the dollar's strength, there could be pressure that could push it further?
Well, right now it's like 61 or thereabout, and for me, I think the range has been around about 60.5 to 61.5. 62, I think, is still seen as a very strong floor. And if you remember, before the election, Raghuram Rajan actually said that the kind of range that he would be happy with for the rupee would be 62 to 58, and that has been pretty much the range since April. Now, you mentioned the dollar strength. Yes, I do anticipate dollar to remain strong for much of this year, in particular later this year. So we could see the 62 being tested. But meanwhile, I think the kind of range that we have seen so far has been pretty decent. The RBI is pretty happy with this kind of range, I would think.
Do you think a rate cut is a sufficient condition but not a necessary condition for a new economic cycle? Because even if rates they come down by 25 bips or 50 bips, that's not going to change anything till the time government reforms or government policy measures don't stabilize.
It's the other way around. I think rate cut will be a necessary condition but not a sufficient condition in itself for growth to accelerate. Basically, the rate cut would be sort of to accompany other policy measures like reform, and then you definitely get growth. I think so far the Narendra Modi government has sort of disappointed the market in that the expectation was high. As of now, at least through the budget, there wasn't very many new initiatives, and the budget also didn't provide any clear direction insofar as fiscal consolidation is concerned. So I think there's still a lot of factors that the market is looking out for, and beyond that, obviously, for growth we need clearer approval channels and rationalization of subsidies. I think those would be key measures. And to complement that, if you get rate cuts, then it will be a necessary condition and sufficient condition for growth. In itself, not, but with reform, definitely yes.
So going forward, Nizam, what is it that you're expecting, given your outlook on rates as far as the yield in the 10-year benchmark is concerned?
Right. For me, I think the pressure on rates for now is for rates to go higher alongside US rates, alongside as well the measure to cut SLR, where banks can now sell their SLR holding, and therefore I think short term, at least in the short term, rates will be pressured higher. Going forward, though, I think reform is an important factor. I think fiscal consolidation is an important factor for yields. And in the US, I think what the US would do with interest rates would be key as well. We expect the Fed to start to increase interest rates from March next year. That's way ahead of market expectation. And if that were to play out, then I think global interest rate pressure would be on the upside. But with reform, then India could see yields going up at a slower pace than the rest of the world. You'd get support from fiscal consolidation, for example. So those are the kind of things that I'm expecting in the months ahead. But in the short term, upside to yields is expected.